The ultra-risky game of futures and options is about to change. After repeated warnings about the unchecked speculation by retail traders in derivatives,
if 50-60,000 crores in a year is going away from household saving into losses in F&O segment, whereas that could have been productively deployed as a part of maybe the next IPO round, maybe the mutual funds, maybe more productive uses for the economy. Why would you say that that's not a macro issue? At 50-60,000 crores, that's pretty macro according to me.
the market's regulator, that is SEBI, finally cracked the whip this month. The big headline is only one weekly expiry per exchange, which basically means traders now have fewer opportunities for short-term trading. Another big change is an increase in the contract size to a minimum of 15 lakh from 5 lakh now. This raises the entry barrier for small traders. How? By making it more expensive to trade. The changes start rolling out from as early as next month. But what was the need for these measures? Is this the first time SEBI's done it? What's the long-term impact? We'll answer all these questions and more in today's podcast. It's Tuesday, the 22nd of October. I'm your host, Himani Kothari, and this is the Morning Brief. Let's start with SEBI's reasoning behind these measures. To understand the scale of retail participation in options, here are some mind-boggling numbers. Retail participation in index options has increased from 2% in FY18 to a whopping 41% in FY24. And 91.1% of these traders actually lost money. That's 9 out of 10. And what's the scale of the losses? 1.81 lakh crore. That's right. That's how much individual traders lost in F&O between FY22 and FY24. Here's another one for context. The notional turnover in derivatives is higher than India's GDP. But F&O is a zero-sum game, right? So if small traders are losing, who's winning? The big guys, of course, which would be the proprietary traders and FPIs, most of whom use algorithms to trade. So essentially, it's a transfer of wealth from the small fish, which is you and me, to the big guys. But just what about F&O ticks? Or in other words, what draws millions of investors every year into the sophisticated segment of the stock market that was meant to be used by professionals to hedge their positions? The one-word answer is leverage. The effective leverage on an index option on expiry day is 500x. That's according to an Axis Mutual Fund report. And most of these options are traded on expiry day. What this means is most traders are buying contracts in the morning to sell in the afternoon, sometimes holding them just for minutes because the leverage is exponential on the last day. This is what SEBI is trying to change by reducing weekly expiries to 2. Other changes include the removal of calendar spread benefit on expiry day, additional margin requirements on expiry day for short sellers, intraday monitoring of position limits, and upfront collection of premium from options buyers. But remember, this isn't the first time SEBI's cracked down on F&O. It had earlier tightened the rules for finfluencers dishing out advice all over social media. These guys were working with brokers on referral programs. What do I mean by that? You see, they were getting paid a bomb just to get people to open trading accounts and have them trade like crazy. This is what SEBI changed the rules for in June. But let's talk about SEBI's latest action. For that, we have with us today markets veteran Deepak Shenoy, founder of Capital Mind. Hi Deepak, welcome to the Morning Brief.
Hi Himani. Great to be here. Thank you so much for inviting me.
Deepak, if you had to use one piece of data to explain the scale of F&O badness, something that hits home, which one would you pick?
So one of the things that we have to look at is, FNO started in 2004. In fact, in 2000, perhaps as a replacement for the Badla system, it was generally more futures than options. Today, the scale of the options market is so huge. The number of contracts of options that are traded on indexes in the world, I think India is one of the highest or the highest in the world compared to exchanges which have had options for 5 or 6 decades, like the US, or maybe even more. India started 2 decades ago, and we're already the highest in the index options piece. And in single stock futures, India is the biggest market in the world. So to the scale that we're talking about 100,000 crores changes hands every day in the cash market, which has gone up about maybe 4x or 3x from 2007. Just to give you an idea of roughly how the volumes have moved. Today, the single stock futures market has probably moved correspondingly higher into a similar about 200,000 crores maybe. But the options market has gone up multifold to the extent of per month, possibly about 200 trillion rupees, 200 lakh crores is traded on a notional basis. Of course, the actual numbers in terms of amount that's changing hands is much lower. It's probably 1/100th of that. But you're still looking at option premiums in the hundreds of thousands of crores being traded every day. This used to be 3 or 4,000 crores in 2004 to 2007 timeframe, and now it is more than 100,000 crores per day. So it is absolutely massive in terms of the scale that is happening in comparison with almost every other part of the same market, which is the equity market itself.
And what is your assessment of the new rules? Who will be hurt? And more importantly, who will it benefit?
Some of the rules will do is to deter people bringing in really small amounts of money, hundreds and thousands of rupees, early thousands of rupees, simply because they've increased the lot size for people who are buying it, changes the expiry schedules for each exchange having only one index on which they can do a weekly. So that means instead of having one expiry every day, and every exchange has now something expiring on that day and something else expiring on the next day and so on. Now every exchange will have only one thing expiring in a particular day in a week. By reducing the number of days that such a gambling thought process can work, it might reduce the amount of people who come and try and just do this only on a daily basis. It'll hurt the exchanges because the volumes will overall come down. If people are coming only to play one particular stock or one particular thing, just as an example, if something is expiring on a Monday, the volumes on Monday for that particular index's futures are substantially higher than anything else in the market on that day. When you don't have something expiring on an everyday basis and most people are coming to play that one thing, then you're going to get a lot lesser participation overall. So volume should come down. Brokers make revenue on volumes. They will get hurt as a downstream measure. Perhaps incomes of participants that may be different layers of players, the clearing corporations, the float income that is earned by maybe custodians, maybe floating participants, and so on. All of this will get impacted. I think it will be meaningful, but we'll only know after the 20th of November this year.
Would you say that rules make intraday trading in cash now more lucrative? And do you see some of the volumes shifting there?
No, because, that's the thought process. But here's the thing. If you're a gambler, you're not going to come and play in stock market because it's very slow. Nobody wants to make money slowly. What will happen is the cash market will have a higher percentage, but it will have a higher percentage of a smaller overall volume pool, which means if I was doing 100,000 crores a day, all inclusive of options and stocks and all that stuff, tomorrow I will have only 40,000 crores. The equity market volume may still be only 5,000 crores, but it's 5,000 out of 40,000 total versus 5,000 out of 100,000. So it will appear like their market share of equity trading has gone up, but it actually doesn't mean that. It means the options trading volume has gone down considerably and market share of everything else may have gone up.
Deepak, what happens to people who already hold contracts that are expiring well after the rules come into effect, say a July 2025 contract? What happens to
those don't change because the only thing that are changing are the weeklies. The monthlies remain as they are. There's one rule though that will change for them. The lot size of the Nifty probably goes up 3x. What is 25 now is 75 after November 20th. which means that the lot size will go to 75. That means if you have a lot of 25, you will not be able to trade it after this cutoff date, right? Because the minimum lot size to trade a Nifty contract, whether it was 2025, 2027, whatever, is still going to be 75 shares. So you're going to have to buy two more lots before that. So you should do that in advance and have at least 75 Nifty, options positions, even on those long-term contracts or a multiple of 75 in order to be able to trade them. Otherwise, you can't do anything with a 25 lot contract until it actually matures. It's just that you have to remember to do something beforehand right now itself to buy enough shares, to enough more option contracts or square them off right now, because otherwise you'll have to deal only in contract size of 75.
Deepak, the contract size increased from 2 lakhs to 5 lakhs in 2015. It clearly did not have a long-term impact because here we are today. A section of market traders is again writing obituaries of FNO. Do you see a repeat of 2015 or do you think the impact this time will be long-term?
There's no long term. India's GDP keeps going up, per capita income keeps going up. So people who can do 5 lakhs today will, in a few years, be able to afford the 15 lakhs. And I believe it's a good thing that the contract size is increasing, that we should absolutely have higher meaningful numbers, but we should also allow Indian institutions to participate in a much bigger way, for which the SEBI's rules currently don't allow. So our mutual funds and perhaps the new asset class that the mutual funds are being given, the PMS players like us and few of the AIF players, we should be allowed to participate in a much more meaningful fashion, especially if we are able to hedge our positions, which will allow people with more money to also come in and participate where they can't today. So, it's just a matter of time, according to me, that eventually people will start participating in these markets regardless of what the contract size is.
Deepak, SEBI also recently cracked down on finfluencers. How much of the volumes do you think were being driven by them, especially the ones who are working with brokers on referral programs?
Yeah, many of them do drive this, because the hero and zero and all these words are coined by mostly the influencing community. And because the options market is not really the same as a casino, in the sense that in the casino, the house wins everything. In the options market, because the losses and profits are spread out, the same person can make losses for 7 days and then profits for 3 days. Now, when the numbers start to increase, the influencer community may still say, listen, find more money, come, you can still make money and so on. But people may not be able to find that kind of money at all. And because SEBI is now not allowed influencers to be paid directly by brokers or even indirectly by brokers in terms of having brokerage shared and all that stuff, the chances of that revenue trickling down into the influencer community becomes lesser and lesser and lesser. And over time, if that is the way things move, the influencer community will also stop. So I do expect that the influencer community will reduce its content and therefore reduce the influence they have on the options trading community.
Is there anything else, in your opinion, the regulator could have done or should have done sooner? You talked about allowing domestic institutions to participate. Is there anything else?
I don't think this is a problem. I think people keep saying, the 83% and 93% make losses and therefore they should be doing something. It is not a problem. People are not entitled to profit. So if you're going to make losses, there is no reason a regulator say, oh, most people are making losses, let's shut this down. I think it's a very bad attitude. That's like trading is a performance sport. The regulator's done what they can to protect the system from a systemic risk issue where people lose so much money that they make their brokers go bust. They have done this meaningfully well with increasing lot sizes, changing the number of expiries because the exposure there seems to be meaningfully large and can cause systemic issues and so on. But they shouldn't ban people. In the US, things are more restrictive. You have to remember that if you want to do things like this, a broker has the right to say, you need to pass an exam or show us that you have 5 years of experience doing this. Otherwise, we're not going to give you this margin-based trading at all. So those rules have been created by brokers to protect themselves in case people put a lawsuit saying, you shouldn't have allowed me to trade this in the first place. Brokers are loath to do this because in India, everything has to be driven by a regulator. Because if one broker does it, then the other broker says, no, I won't do it. So more volume can come to me. And then it changes the structure of it. But RBI could maintain, for instance, people who they've done this in one case. They've said the concentration in certain brokers may be very high. For February 2025 onwards, there will be 4 intraday checks of which broker has the maximum intraday positions also. And if those positions are greater than some 4 or 5% or something like that of all volumes, of all open interest and volumes, they will not allow that broker to increase their position. So that means a broker concentration risk is also going to be removed. So in that context, I don't think there is much more that the regulator should be doing. I think what SEBI is doing is the right thing, just to create a system where people can participate, but avoid any systemic risk issues by increasing their regulatory oversight and changing the rules to make sure that more well-heeled players can play, so that people who come in have adequate training and backing in order to be able to participate.
The FNO craze didn't just bother SEBI. In fact, this year's economic survey talked about how FNO caters to your gambling instincts. The finance minister herself has on several occasions warned against any unchecked explosion in FNO and the challenges it could create.
Any unchecked explosion in retail trading of futures and options can create future challenges, not just for the markets, for the investor sentiment, and also for household finances.
She also raised the securities transaction tax in the budget to discourage retail traders from gambling with their household savings. Let's now listen to Sudhakar Reddy, Associate Professor of Finance and Control at IIM Calcutta, who explains the impact of the new rules at the macro and micro level. Professor, we are talking about the FNO craze and the massive retail participation that has the government and the SEBI worried. I remember the last time we spoke, you were skeptical about the working committee's suggestion to increase the FNO lot sizes by many times. Professor, the rules are now out and the lot sizes are up nearly 3 times. What's your view on this? Do you think this will restrict the entry of small traders, or do you believe people will now borrow more to lose even more?
SEBI has increased the lot size from 15 lakhs to 20 lakhs, which was from 5 lakh to 10 lakh previously. So this means that the lot sizes will definitely increase by 2.5 to 3 times for each of the options contract. Now, SEBI assumes that this will not allow the retail participants to come into the market because the premiums will increase. But here, my view is this will not deter the retail participants to the market because retail participants are basically option buyers. For example, let's say in Nifty, if I have to buy an ATM contract right now, the option premium per lot is, let's say, 5,000 rupees. Now, if SEBI increases this to 3 lots, the option premiums will go up to, let's say, 15,000. So, an option buyer previously used to buy at least 1 or 2 lots or 3 lots. Now, what happens? He will buy only 1 lot. So, in a way, there won't be any significant difference in terms of the quantity. Maybe the lots are changing, but the quantity remains same. More or less same. I will not say exactly same, more or less same. So that means I don't see there will be a deterrent in terms of this one. However, there may be losses more and more because now the retail participants have another problem. The weekly expiries in Bank Nifty and other weekly expiries have been discontinued. So this means the retail participants have to bring more money, which may result in more losses.
So, Professor, do you then think that people will buy far out of the money options now?
That's a very important point you raised. Yes. For example, if I don't have more money, what I will do is I'll buy far out of the money options, which results in more losses more easily because far out of the money options are always out of the money and they don't give returns to the investors.
Professor, from a liquidity perspective, would it have been more prudent to launch more financial literacy initiatives instead of rolling out some of these measures?
Yes. So actually, I have been concerned about the liquidity of the Indian markets, especially in the derivatives market. Let me give you some data here. If we look at developed markets like NYSE, so NYSE has around 5,000 stock option contracts with weekly expiries, monthly expiries, and expiries ranging from 1 month to 1 year. Whereas if we take Indian market, we have hardly 180 to 200 stocks on which we have option contracts. Out of 2,300 or 2,400 means hardly 10%. And also, let me highlight one more important point. Out of these 200 option contracts or future contracts, liquidity is very high only in the top 30 to 40 contracts. That means outside of the Nifty 50, we don't see the kind of liquidity that we see in any developed market, which means by the new measures, liquidity is going to further come down because obviously volumes will come down, which is a real concern. SEBI should have come up with some idea like educating the investors, and also not just educating the investors. The best thing would be there is a entry criteria like an examination. I don't say that the examination should be very tough. You can have the basic modules of the NCFM examination that we have, which the investors or traders should clear, which is good for them because they need to understand the basics of the derivatives markets, the mechanics of the derivatives markets, which is very essential. Because now I can tell you with my interaction with some novice traders, they don't even understand what is time decay. They don't even understand what is implied volatility. They don't even understand the difference between weekly expiry versus a monthly expiry. So because of these reasons, they lose money quickly. And also, it is very important that for the overall development of the market, the investors and the traders are well educated.
Professor, the regulator had called the explosive growth in F&O volumes a macro threat. Do you agree with that?
Yes, I would not say a threat, but there are some macroeconomic issues. The first one, which SEBI chairperson herself mentioned, is that there is no capital formation in the economy. For example, banks are not getting fixed deposits, or people are not channelizing their money in productive financial instruments. Rather than they're going into the speculative instruments, which are the F&O contracts. And nowadays, let me tell you what is happening in the market. 50 to 60% of the trades are executed with the algorithmic trading. Now, the problem for the macroeconomy or systematic risk perspective is when we have algo sitting everywhere, if there is any news or any mishappening like any wrong trade placed, will trigger these algos and then it can result in the overall market crashes. And also, what happens to the markets due to a black swan? The problem comes mainly because of these F&O trades. Because F&O trades are generally done by the, what you call, the algos. So that's where the macro threat is there. And I agree with SEBI's chairperson's views on this.
And Professor, SEBI announced the new rules this month, but the daily turnover had already been falling since June this year. Is that because of some fundamental changes in the market, or is that in anticipation of the F&O curbs?
I have seen the data. What I can see is the premiums in the futures market as well as the options markets in the equity segment, there's not much change. However, if you look at the interest rate derivatives, currency derivatives, they're actually very liquid. So overall, what I see is there's no change systematically because people are not anticipating anything right now. As I told you, people will not leave the market irrespective of whatever we do. Whatever you're talking about in terms of reduction in the volumes or turnover is basically maybe the FIAs have been continuously selling over the last few months. But overall, I don't see a significant change in the trading volumes except for the interest rate derivatives as well as the currency markets.
And so do you think some of the volumes may now move to currency derivatives?
So the currency derivatives market is very vibrant in the OTC segment. It's a 24-hour market. OTC segment is very popular. Hence, I don't see significant volumes coming in here because even if you look at the kind of movement that we see in the currency markets or the kind of movements we see in the interest rate derivatives markets is very limited actually. Whereas if you talk about index derivatives like Bank Nifty, why everybody is attracted towards Bank Nifty is there's a huge volatility. Bank Nifty goes up by 300 points in just 5 minutes. So that kind of move we cannot see in the currency markets because currency markets are driven by the actual demand and supply of the currency. Whereas if you look at stock derivatives or index derivatives, these are purely speculative. Hence, I don't see the volumes picking up in India, at least in the near future.
So there you have it. SEBI steps are definitely going to change the rules of the game. But the jury is still out on whether this will make a significant change to the loss figures we've seen retail traders racking up. That's it for today. This episode was produced by Vinay Joshi and sound designed by Rajas Naik. We hope you liked the episode. Do like, share and subscribe if you did. The Morning Brief drops every Tuesday, Thursday and Friday on a listening platform of your choice. Also, don't forget to catch our 2 other shows, 7 at 7, which is your daily capsule of financial news from India and the world. There's also ET Wealth and Beyond, a special limited podcast series in collaboration with BSE. It's about the world of markets and investing. Listen to them wherever you get your podcasts. This is your debutant TMB host Himani Kothari signing off. Have a good rest of the week.